everybody is looking at the wrong number. We keep score on how much the big technology companies are spending on artificial intelligence. $700 billion this year, maybe more. And we read that as strength because these are the greatest cash machines ever built, so of course they can afford it. Here's the thing nobody put on a chart. They stopped affording it. Somewhere in the last 18 months, the money stopped coming out of the business and started coming out of the bond market. And that changes what this trade actually is. Let's start with what's true, because the bull case is real and I'm not going to strawman it. The spending is enormous. Depending on who's counting, the biggest cloud companies will spend somewhere between $690 and $750 billion this year on infrastructure. That's up around 67% in a single year, and it's the third year in a row of growth above 60%. Roughly 3/4 of it is artificial intelligence. That is not a rumor. That is guidance these companies gave out loud. Now here's the number that reframes all of it. 18 months ago, incremental debt was about 9% of what these companies were spending on capital projects. By the middle of this year, it was about 32%. They went from paying for it out of pocket to borrowing roughly a third of it. Same spending story, completely different financial story. And then in July, Alphabet did something it had never done before. The company that prints money reported a quarter where the cash flow went negative. First time, its long-term debt more than doubled in 6 months, up about 111% to roughly $98 billion. Analysts now expect its free cash flow for the whole year to come in around $8 billion, which is a drop of something like 90%. This is Alphabet. This is the business people use as the definition of a cash machine. I'll put the two numbers next to each other because this is the whole video in one frame. 9% to 32% in about a year and a half. The buildout didn't get cheaper and the ambition didn't get smaller. What changed is who is funding it. And once somebody else is funding it, somebody else is carrying the risk, and that somebody expects to be paid. Which brings us to the 10th of August and the announcement that made me want to make this video. Nvidia said it is partnering with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR. 6 of the largest pools of capital on the planet. The goal, in Nvidia's own words, is to mobilize over $500 billion of third-party capital to build artificial intelligence infrastructure. $500 billion, and read the structure because the structure is the story. These are memorandums of understanding designed so outside investors fund the build-out without adding directly to Nvidia's balance sheet. That sentence is not a criticism. It is the design. It is doing exactly what it was built to do. What are they selling those investors? They're selling compute as an asset class. The pitch is that a data center full of chips looks like commercial real estate or a toll road. A big thing you build once that spits out predictable cash for decades. Pension funds and insurers love that shape. They have to match long promises with long assets. And if artificial intelligence compute really is a toll road, this is one of the great financing innovations of our lifetime. Here's where I get uncomfortable. A toll road is still a toll road in 20 years. A graphics chip is not. The hardware at the center of this gets replaced on a cycle measured in a couple of years because the next generation is dramatically better and your competitor is buying it. So you have an asset that ages like a laptop, financed with paper that behaves like a bridge. That gap has a name in finance. It's called a duration mismatch, and it is the thing that has broken more institutions than fraud ever has. You can already see it showing up somewhere most people don't connect to artificial intelligence at all. On the 13th of August, the United States sold $25 billion of 30-year bonds, and it had to pay 5.22%. That is the most expensive 30-year money the government has borrowed since 2001. Demand was soft. The bid to cover was 2.39. The dealers who are obligated to show up had to absorb 11.5% of it. Now, deficits are the biggest driver there, and I'm not going to pretend artificial intelligence caused that number. But a wave of new corporate borrowing for data centers is competing for the exact same pool of long-term savings. When everyone needs to borrow long at once, long money gets more expensive for everyone. Now the honest counter-argument, and it's strong. These are investment-grade companies with enormous businesses that have nothing to do with artificial intelligence. The capital is third-party, not vendor financing, which is the thing that actually killed the dot-com era when the seller lent the buyer the money. Larry Fink has compared this to the birth of mortgage-backed securities in the 1970s, and he means it as a compliment, a genuinely new way to fund something the world needs. He might be right. So here's the falsifiable version, and you can hold me to it. My call is that the debt-funded share of this build-out keeps climbing from that 32% through the middle of 2027. If it flattens or falls, I'm wrong, and the cash machines were fine all along. Well, that's the read. This stopped being a story about how clever the technology is and quietly became a story about how it's financed. And credit stories don't end when the technology disappoints. They end when the funding gets expensive. So the number I'd watch isn't the next model release. It's the next auction. Is this still a growth trade to you, or is it a credit trade now? Tell me below. I genuinely want to read the disagreement. This is the asymmetric signal. One contrarian read a day. Subscribe, research and education only, not financial advice.